In the previous video, we discussed the first step to build the DCF valuation, and in this video, we'll discuss how we calculate working capital. So working capital is calculated as accounts receivable plus inventory minus accounts payable on the balance sheet. Now you may recall that accounts receivable represents the money that customers owe to us. Accounts payable is the money that you owe to the suppliers. And inventory refers to the value of raw material under processing and finished goods. Now, if a company's accounts receivable increase at the end of the year, this means that the firm collected less money from its customers than it recorded in sales during the same year on its income statement. On the other hand, if accounts payable were to increase, it means a firm is able to pay its suppliers more slowly. The value of inventory going up means more money is locked up as raw material. Cash conversion cycle and forecasting change in working capital. Now you may be wondering, how can you forecast this change in working capital for future to arrive at future cash flows? For that, we need to learn the concept of cash conversion cycle. Simply put, CCC refers to how many days it takes for the company to convert inventory into cash. Let's learn this with the help of an example. Recall the coffee shop example we had taken up in the previous module, and say following are the numbers available from financial statements of your coffee shop at the end of year 1. Sales rupees 18,000, cost of goods sold or COGS rupees 12,000, AR rupees 4,000, AP rupees 2,000, and inventory rupees 3,000. So we want to arrive at cash conversion cycle for our coffee shop and use that to forecast change in the working capital in year 2. Now cash conversion cycle consists of 3 components: days sales outstanding, days payable outstanding, and days inventory outstanding. Let's understand these terms one by one. Days sales outstanding, that is DSO, simply put, means on an average, how many days does it take for you to collect the payments from your customer after a sale has been made. It is calculated as accounts receivable divided by sales multiplied by 365. In our example, we know that accounts receivable is 4,000 divided by sales, that is 18,000, multiplied by 365, that is 81.1 days. So our DSO given the example is 81.1 days. On the other hand, days payable outstanding, DPO, means on an average how many days credit do you get from your supplier. That is, within how many days do you have to make the payment to your suppliers after you have made a purchase from them. It is calculated as days payable outstanding, DPO, as accounts payable divided by cost of goods sold, COGS, multiplied by 365. Our accounts payable is 2,000 divided by 12,000, that is COGS, multiplied by 365, that is 60.8 days. So our DPO given the example is 60.8 days. Similarly, days inventory outstanding, DIO, means on an average how many days does it take for a company to hold its inventory before it can be sold. It is calculated as days inventory outstanding, inventory, that is 3,000 rupees, divided by COGS, that is 12,000 rupees, multiplied by 365. So that is 91.2 days. So our DIO is 91.2 days. So cash conversion cycle for a company is the time it takes the company to convert its inventory into sales plus the time it takes the company to convert sales into actual cash inflow minus the credit period it receives from the supplier. So in this case, our cash conversion cycle is days inventory outstanding plus days sales outstanding minus days payable outstanding, which is 81.1 plus 91.2 minus 60.8, that is 111.5 days. Now to forecast accounts receivable, accounts payable and inventory, we use DSO, DPO and DIO, and once we have AR, AP and inventory forecast with us, we can simply calculate working capital for that year as accounts receivable plus inventory minus accounts payable. And by comparing a particular year's working capital with that of the previous year, we can calculate the change in working capital, which can then be used to arrive at free cash flow. Now let's say that for our coffee shop, the sales is expected to grow at 10% for next year. What would be the forecast of various working capital items? Sales next year 18,000 multiplied by 1 plus 10%, that is 19,800. COGS divided by sales of current year is 12,000 divided by 18,000, that is 16.67%. So COGS for next year basis 19,800 sales multiplied by 66.67 is 13,200. We know that our DSO is 81.1. So our AR for next year divided by the sales multiplied by 365 is 81.1. When we solve for AR for next year, it will be 4,399 rupees. Similarly, DPO is 60.8. We know that next year COGS is 13,200. Basis 365 days, we calculate for AP and that comes to 2,198. We also know that DIO, which we calculated earlier, is 91.2. Given our COGS is 13,200, our inventory basis 91.2 as DIO is 3,298 rupees for next year. So our current working capital is 4,000 plus 3,000 minus 2,000, that is 5,000. However, next year we see that it's 4,399 plus 3,298 minus 2,198, that is 5,499. So with the increase of 10% sales, we have to invest rupees 499 extra for next year in working capital, which is needed to support the increased sales. In the next video, we will discuss step 2 and step 3 to arrive at DCF valuation.